Welcome to the Deep Dive. You ready to get smart about investing? Today we're diving into The Intelligent Investor.
A classic.
Yeah, classic. This book is all about making your money work for you, for the long haul.
It really is. And, a lot of people want to get into investing, but it can be kind of intimidating.
Absolutely.
There's so much information out there, it's hard to know where to start.
That's where this deep dive comes in, right? We're giving you the shortcuts, the cheat sheet to this investing wisdom.
Exactly. No need to wade through hundreds of pages.
Exactly. So the first big idea, and I think this is what a lot of people are really interested in, is value investing.
Yeah, and that can sound kind of, jargony, but really think of it like,
Like a treasure hunt.
yeah, you're at a flea market digging through boxes and you find that hidden gem that everyone else has overlooked.
You see the value that no one else sees.
Right. And that's what value investing is all about. You're looking for those stocks that are undervalued by the market, but have huge potential for growth.
So you're buying low and hoping to sell high.
Exactly. Benjamin Graham, the author, he's got some amazing examples in the book.
He does.
One that really stands out is his story about Northern Pipeline Co.
Oh, yeah, back in the 1920s.
Yeah. He realized that this company was trading for like $65 a share, but get this, they had $80 per share in bonds alone.
Wait, so the company was literally worth more than its stock price.
Exactly. It's like, buying a dollar for 50 cents.
That's incredible. So what did he do?
Well, he saw the opportunity, bought a bunch of those shares,
Smart move.
and then he kind of nudged the company's management, hey, why don't you increase your dividends? A few years later, he sold those shares for like $110 each.
So he more than doubled his money.
Yeah, it just goes to show you that, value investing can be incredibly rewarding.
And it all comes down to recognizing that inherent value that, like you said, everyone else is overlooking.
Yeah.
But I imagine it takes a lot of discipline to stick to that value investing approach, right? Especially when the market's going crazy.
It does. It does. And that brings us to another, really important point that Graham emphasizes, avoiding market speculation. It's so easy to get swept up in the latest trends, the fear of missing out.
Oh, absolutely. Like when everyone's talking about a certain stock and you feel this pressure to buy it,
Right.
even if you have no idea what the company actually does.
Exactly. And that's when people tend to make mistakes. Graham really stresses that you need to focus on companies that have intrinsic worth, companies that are fundamentally sound, regardless of all the hype.
So don't buy into the hype.
Exactly. It's funny, even the greatest minds can fall prey to speculation. Remember Sir Isaac Newton?
The guy who discovered gravity, what does he have to do with investing?
Well, believe it or not, even Newton got caught up in a speculative bubble, the South Sea bubble.
Oh, wow.
He lost a fortune.
So even a genius can make bad investment decisions.
It just shows you that emotions and investing don't mix well.
So we need to be level-headed, right? Not get caught up in the frenzy.
Absolutely. Instead of chasing the hottest trends, focus on those solid companies that are built to last.
Those companies that have, like you said, real value,
Exactly.
not just hype. Now, this next concept is one that I think a lot of people have heard of, but maybe don't fully understand. Diversification.
The classic don't put all your eggs in one basket idea.
Right. But why is it so important? Like, wouldn't it make more sense to just put all our money into the investments we think will do the best?
It might seem that way, but think of it this way. You wouldn't eat the same food every day.
Right? Well, I mean, I do love pizza.
Even pizza lovers need a balanced diet for optimal health. Similarly, a diversified portfolio helps you manage risks.
So if one investment goes sour,
The others can help cushion the blow.
I see. It's all about spreading the risk.
Exactly. Graham gives specific examples in the book, like his suggested portfolio split between bonds and stocks. That balance helps protect against inflation and those inevitable market swings.
So diversification is like a safety net for our investments.
Exactly. It helps you sleep better at night knowing that, one bad apple won't spoil the whole bunch.
And speaking of safety, Graham also talks about the importance of the margin of safety. Now that sounds intriguing. What exactly is that?
It's kind of like a built-in cushion,
Yeah.
a buffer to protect you from potential losses.
So you're not losing everything if things go south.
Right. Think of it like buying a used car.
Okay.
You wouldn't just pay top dollar without, checking under the hood.
Of course not.
You'd want to make sure there are no hidden problems.
Right.
The margin of safety is all about investing with that extra bit of wiggle room, just in case. And it's particularly relevant now, given what's going on in the market.
What do you mean?
Well, back when Graham was writing this, early 2003, bond yields were really low.
Okay, yeah.
So having that extra layer of protection was even more crucial. But how do we even determine that true worth of a company?
Yeah, because stock prices are always bouncing around.
That's where Graham's concept of Mr. Market comes in.
Mr. Market. Who's that?
It's not a real person, but he's like this character that Graham created to represent the market.
Okay.
He's this unpredictable guy, always offering to buy or sell your stocks at, sometimes crazy prices.
Like that friend who's always trying to get you to buy something you don't need.
Exactly. And the point is, we shouldn't let Mr. Market's mood swings dictate our decisions.
We need to stay focused on the long game.
Right. Like the underlying value of the businesses, not the day-to-day fluctuations.
Tune out the noise, right?
Exactly.
But that's got to be tough when you see people making quick profits by jumping on the latest trends.
It is tempting. Remember Sir Isaac Newton and the South Sea Bubble?
Yeah, even geniuses can get it wrong.
Exactly. Graham's all about the long-term perspective. Stick to a solid strategy even when things get chaotic.
Don't panic.
Exactly.
Huh.
What about those professional money managers? Shouldn't they be able to navigate the market for us?
Yeah, that's what they're paid to do, right?
Well, Graham talks about mutual funds. And, this was before index funds were really a thing.
Right.
But he points out that a lot of these funds feel this pressure to, chase performance.
They want to beat the market.
Exactly. And that can lead to some, questionable decisions.
Like buying high and selling low.
Exactly. And that hurts the individual investor in the end.
So even the pros can make mistakes.
He actually looked at the performance of some top-performing funds from 1967.
Those funds that were crushing it.
Yeah, and you know what? A lot of them actually underperformed the market in the following years.
Wow, so past performance isn't always a good indicator.
Exactly. It's like, those athletes who have one amazing season and then disappear.
One-hit wonders.
Right. So what's the takeaway here? Do your homework.
Don't just blindly trust the funds.
Exactly. Look at their fees, their long-term track record, and most importantly, their investment philosophy.
Make sure it aligns with those value investing principles we've been talking about.
Exactly. But what if we decide to go it alone and invest in individual stocks? How do we actually find those hidden gems?
Yeah, how do we do that?
That's where security analysis comes in. And Graham spends a lot of time on this in the book.
He breaks it down.
He gives you this whole framework for evaluating companies, looking at their financial strength, their earning stability, their growth potential.
So it's not just about gut feeling.
No. You got to dig into those financial statements, look at balance sheets, income statements.
Numbers.
Exactly. It's all about understanding what you're buying.
Not just buying something because it's popular.
Exactly. Remember, we're looking for bargains, those stocks that are trading for less than they're actually worth.
Like finding that vintage treasure at the flea market.
Right. But it takes work.
So where do we start?
One of Graham's classic techniques is to look for stocks that are trading below their net working capital.
What does that even mean?
It basically means you're buying the company for less than the value of its liquid assets.
So you're getting the rest of the business for free.
Pretty much.
Yeah.
It's a powerful strategy.
Are there any examples in the book that, show how this works?
He does, yeah. One that comes to mind is back in the 50s, there was this company, what was it called? Oh, National Presto Industries?
I've heard of them.
Yeah, they made pressure cookers,
Okay.
But anyway, their stock was trading for like $8 a share, but their net working capital was over $16 per share.
So you could have basically bought the company for half its worth.
Exactly. And, it's not just about finding the super cheap stock, it's about understanding why they're cheap.
Right. There's got to be a reason.
Exactly. Graham talks about the Penn Central Railroad.
Oh, yeah. That was a big deal when they went bankrupt.
Huge.
Yeah.
And Graham shows how if you, really dug into their financial...
balance sheets and all that.
Yeah, there were warning signs years before the collapse.
So you got to be careful, even with big companies.
Exactly. Due diligence is key. He also looks at some high-flying companies like Ling Temco Vought.
I don't know that one.
Yeah, they grew really fast. Okay.
But it was all fueled by debt, and it eventually caught up with them.
So debt can be a red flag.
Definitely. Especially in uncertain times.
Yeah.
What about IPOs? Those initial public offerings, everyone gets so excited about those.
Yeah, it seems like everyone's trying to get in on the ground floor.
Graham's pretty cautious about IPOs.
Really?
Yeah, he says a lot of them are, low quality and overpriced.
Just type.
Exactly.
Hmm.
He gives this example of AAA Enterprises, a small company that went public during the franchising boom.
Okay.
Investors went crazy for it, the price shot up, and then boom, bankruptcy a couple years later.
So buyer beware.
Right. It's not all sunshine and roses.
Mm,
So, so how do we know which companies are actually worth our money?
that's $1 million question.
Graham says, look for companies with a track record.
Companies that have been around for a while
Yeah, companies that can weather the storms.
make it through those tough times.
Exactly. He also talks about, the relationship between shareholders and management.
Oh, interesting. Yeah, he thinks shareholders should be more active, hold management accountable.
So we're not just passive investors, we're owners.
Right. And remember that idea of the investor's personal portfolio policy?
That's interesting.
He says, your approach to investing should depend on you, your temperament, your knowledge, your experience.
Not just how much money you have.
Exactly. He talks about two types of investors: the defensive investor and the enterprising investor.
Oh, yeah, I remember that.
The defensive investor, they're all about stability, simplicity. They don't want to spend all day managing their investments.
So they're more conservative.
Yeah, they might have more bonds in their portfolio, maybe even a simple 50-50 split between stocks and bonds.
Okay, and the enterprising investor.
They're more hands-on, they're willing to do the research, dig into those individual stocks.
They're looking for those hidden gems.
Exactly. But Graham's not saying one is better than the other.
It's about finding what works for you.
Exactly. He also has a lot to say about bond investing, analyzing different industries.
He covers a lot of ground.
He does. But ultimately, his big message is be patient, be disciplined, think long-term.
Investing is a marathon, not a sprint.
Exactly.
Yeah.
Don't fall for those get-rich-quick schemes that usually end badly.
Slow and steady wins the race, right?
Right. So I think a good question for our listeners is, think about everything we've talked about today.
All those key principles.
Value investing, avoiding speculation, diversification, margin of safety, understanding your own investor personality.
It's a lot to take in.
It is. But, given all of that, what steps can you take to build a portfolio that's going to last?
That's a great question. And remember, this was just a glimpse into the intelligent investor.
There's so much more in the book.
So go out there, do your homework, and invest wisely.